The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague, the man who makes deal makers duck for cover. It's Anthony McDonald. How are you, Anthony?
Ready to shoot a few fish in the barrel, James.
Fantastic. Well, this week we look at Donald Trump's great tariff U-turn, we meet the newest member of private equity's Hall of Shame, and we examine the trouble at Macquarie, better known as the Millionaires Factory. Anthony, let's start there. On Wednesday, the boss of the corporate COP, the Australian Securities and Investment Commission, that's Joe Longo, accused Macquarie of what he called complacency and hubris over what he said was the fourth run-in with the regulator in just 12 months. Now, Anthony, explain for us, what's Macquarie actually done here and how is it defending itself?
Do you mean what's it done now, James?
Yes, Mr. Longo.
ASIC is hot on Macquarie's tail. The latest one's about its Australian institutional stockbroking business, which is, where the fund managers buy and sell ASX-listed shares. Yep. ASIC says that business has failed to accurately report the short-selling activity that's been going on through that desk. Now, James, ever since the GFC, stockbrokers have had to report their daily short-selling activities.
Yep.
You might remember short-selling, it's where an investor borrows someone else's shares, sells them, and then tries to buy them back at a lower price in the future.
Gotcha.
It's effectively a bet on a company's share price going down.
Yeah.
Now, hedge funds short stocks for all sorts of reasons, but it really came to light in the GFC, and it was blamed for some of the huge market volatility in the GFC. So regulators like ASIC said, all right, well, this short selling's out there. We're not going to ban it, but let's monitor it by actually recording the data, how much of a company sold short, and let all the other market participants see it so you can see what's going on.
Sounds fair.
Anyway, one of the ways you do that, James, is to get the prime brokers, now they're the brokers that service the hedge funds, like Macquarie, to report their activities, right? And tell the exchange operator and the regulator what they're seeing on their side so that all this information can come together about the wider market.
Got it.
Now, James, Macquarie wasn't recording that information properly, or at least reporting it properly further up the chain. I mean, Macquarie admits that itself. ASIC's statement of claim says Macquarie realised it had a problem in 2022, self-reported it. Everyone looked back further to 2009 when this came in, and it basically hadn't been working right since all the way back then, James. So, I mean, they reckon there could be 70 million plus trades that weren't reported properly. So, it's sloppy at best by Macquarie. If you read through ASIC's 122-page statement of claim, it just shows how many systems they had, how many levels of people and manual processes were involved in trying to report this data, which is a bit of a, it's not their prime sort of focus as a business, James. So I thought Longo's choice of words here were interesting. Now, you're right. You might remember, James, it was only last week Macquarie boss Shamara Wickramanyaka was talking about complacency and the danger of complacency for Australia. And a few days later, Joe Longo's thrown that complacent word back at her face. So, I mean, that's the accusation. But do you think this is a storm in a teacup, or do you think it's actually a real problem for them?
I think this is a problem for them, but not necessarily because of the seriousness of the issue or any one issue. I think Macquarie's got a point. These are all relatively small issues that they have moved to fix. They're a big, complex global organisation. I think it's important to recognise here that we're not talking about individuals' money being under threat. This is a reporting issue. But, I mean, Joe Longo's right when he says in response to that, hey, that doesn't matter. Macquarie's a big organisation with lots of resources. It needs to get this stuff right. It can get this stuff right and it should get this stuff right. Where the concern for me, if I was a Macquarie investor, would be is in the gap between the way Macquarie sees this as a relatively minor issue it's working cooperatively with the regulator to fix, and how Joe Longo sees this, which is a sign that Macquarie has not got this right, and more importantly, I think, that it's sort of at risk of believing its own BS.
Yeah.
That what Joe Longo said to me was, Macquarie's risk and compliance culture and its systems are just not as good as Macquarie thinks they are. And I think that's the problem here, that the Macquarie sort of sees this as, part of doing business. It's got to do better. It is serious about it, and it will fix it. Joe Longo gets that, I think, but he's getting frustrated at the fact that Macquarie keeps saying, "Yep, we're on top of this," and things don't get fixed. I mean, okay, Macquarie says it's self-reported in 2022. Joe Longo says that Macquarie told ASIC in 2015, 2019, 2020, and 2023 this was all sorted out. So you can understand why he's lost patience. The danger here for Macquarie is that we've seen this movie before. We've seen it with other big banks. Once the regulator zeroes in on you and starts finding these little problems, even if they're relatively minor in nature, they start to add up. They accumulate. And eventually you're spending more and more management time not only fixing them, but managing the regulator's expectations. We've seen at other places that can end poorly for some executives or shareholders when they have to spend a whole bunch more money fixing this stuff. So I don't know, Anthony. I don't think it's a crisis point yet, but Macquarie just needs to be careful that it's hearing the regulator, that it's listening and realizing, okay, there's a gap between how we think we're going and how the regulator thinks we're going. We need to close that. Think that's about right?
Yeah, James, look, I read these short selling numbers every day. I love them. It's a great sort of sentiment check. What's hot, what's not, who's the market betting against. Now, I know, I've always known they're not perfect, but I blame the hedge funds themselves. I thought the way they set it all up with nominee companies and all that sort of stuff, that was the problem. And maybe the groups like Macquarie, who we see their name up in the sky every day on the way to work, I've trusted them to get them right. So in this case, James, I think Macquarie's managed to do the wrong thing by its clients, who are the other funds that actually use that information to make investment decisions. They've done the wrong thing by the regulator, ASIC, the exchange operator. And last but not least, James, the investors who buy Macquarie because they're supposed to be good at two things, making money and managing risk, right? Yeah. And this is risk. I think what we've learned about Macquarie through the compilation of these cases that are coming up is that coming out of the GFC, they got very, very, very good at managing liquidity risk, managing their own balance sheet and how they think about the balance sheet risk for themselves, but not so good or a bit behind on that non-financial risk. And things like this is all non-financial risk. They're having to get their systems up to speed to sort of catch up on it because that's the way the society's going. That's the way regulators' expectations are going. And when you're privileged enough to be Macquarie with a license in a market and be a big player in our equities market, then, unfortunately or unfortunately for them, they just got to do this stuff.
Yeah, absolutely. Absolutely right.
Well, James, let's jump into our first topic. And on Monday afternoon, investors got the news they've been waiting for. Peace between China and the US in their vicious trade war. After talks in Switzerland over the weekend, the US agreed to drop its tariff on Chinese imports from 145% to just 30%. And China's tariffs were down from 125% to 10%. Wall Street soared. Trump claimed a big win. Investors breathed a big sigh of relief. But James, who blinked here, the US or China?
I think Donald Trump blinked mainly. Yeah. He brought these tariffs back. The Thursday before this trade deal, he was saying that he thought 80% was about the right tariff to whack on China. We get to Monday and all of a sudden it's down to 30%. And what's China given him? Well, nothing. Yeah. All they've done is promise to have more talks. So I think mainly Trump has backed down after, a few torrid weeks on financial markets. His approval ratings has been a bit wobbly. And the other thing, there's some great data around that shows that has surveyed Americans on what they think of globalization and trade. They love it. Of course they do, because it brings cheap stuff into the country. So he claims this is all sort of negotiating tactics, the art of the deal. I think that's claptrap. He pushed too hard. He got burnt. Yes, the Chinese, they have to get a deal too. Let make no bones about that. The country there is in deflation. It's going backwards. The last thing they need is a trade war, particularly an elongated one. But, they don't have elections over there in China, Anthony. Yeah. So the leaders there can just tell everybody to buckle up. We're going to take a bit of pain. So let's face it, it's good for the country, good for financial markets. This trade war was going to be very nasty and very disruptive. So we've got to pause now. Look, I'm a little bit surprised that the markets have just assumed that there's not more twists in the tail. They just assume that 30% is the new rate. And a lot of investors I've spoken to this week think it's going lower, probably 10% or below that. That's a pretty big assumption given how crazy the Donald is. But look, peace in our time. What a turnaround from the last few weeks. Anthony, we mentioned Wall Street soared, but the reaction on the ASX was actually pretty tepid. How do we explain the difference between what US investors are thinking and what Australian investors are thinking?
Well, James, at one level, I think emotionally we're just over it. We have to tolerate this out of the deal BS, but it's quite un-Australian, isn't it?
Yeah.
Wouldn't it be better if people just say what they meant, what they're actually after? I mean, I don't think investors here maybe rode the ups and downs as much as in the US when you're a bit closer to it, or always a bit skeptical it would go this way.
Yep.
But it struck me this week, James, that it's sort of like the tones of CEOs and investors had changed quite a bit. Everyone's just over the bull dust of it all. Over the 145% was the mark, and then 80% was the mark, and it comes out at 30. There's a massive, massive difference between 30 and 80, let alone 30 and 145%.
It's not how CEOs run their business, is it? They don't do this sort of stuff.
Exactly. They're sick of the dramas, the headlines, and dare I say it, people like us talking about it. And then we hear that companies are starting to employ chief geopolitical officers, James.
Yeah.
And this CFO that you and I met was like, what the bloody hell can you do about geopolitics anyway? Even if the Saudis are doing something with oil and it's going to change the oil price for the next couple of months, what are you going to do about it anyway? You're running your business for long term here or short term or what? So I think here in Australia, we're a bit more over it. But look, James, the more Chanticleer and less ranty answer is that this whole Australian safe haven theme that we've been talking about in the past few weeks, look, as money fled out of the US in the wake of Liberation Day, including from some usually safe haven assets like US treasuries, like the US dollar, some of it come to Australia, James. And we saw that by the pickup in the trading activity on the ASX, the way that the ASX outperformed offshore markets, including Wall Street itself. So some of that money that was, normally parked up there in the US, it came down here, it was looking for big, liquid, non-US exposed defensive sort of names, and it came for our big banks, some of the big industrials like, Wesfarmers, came for Coles, Transurban.
Yep.
And so, James, now that the trade war is over, I mean, is it over? I don't know. But maybe now that the tensions have de-escalated, it's only natural, I think, that we don't rebound to the same extent as the US because we had this money that came here because of the trade war. So I think we've got more conflicting forces here, James. But if you look at our market, though, I mean, we've been ticking along pretty nicely. Nothing's too silly. We're just grinding out the gains. I think we're up 18 of the past 20 days, James, which is a strong run, in any conditions.
Yeah, absolutely.
Let alone now. But, James, the talks between the US and China, I mean, this new deal is sort of like another of these 90-day reprieves. Is the danger over? Do we just go back to normal now? Or do you, our resident bear, still see more pain in the months ahead?
Well, of course I see more pain, Anthony. I wouldn't be a bear if I didn't. Look, I mean, I actually think all this trade claptrap, I think we are sort of probably coming towards the end of it. We're going to see all these deals negotiated, but I think most of the other countries in the world have got Trump's measure now. They know he doesn't really want to whack them too hard. They know that he'll cave and accept a tariff of 10%. So I think the heat will have gone out of that. I mean, there may still be some more twists and turns in the China trade deal because they're just such big geopolitical adversaries. So, yeah, maybe some more twists and turns in there. But we got a question this week through our website. There's a question function you might have seen on the Chanticleer articles on afr.com. And Ryan Kelly sent us a question in about just asking about what happens to Trump's plan. He came in with this plan to reduce the US budget deficit, to get that down from, say, 7% of GDP to 3% of GDP. But a big part of it was the revenue that would be raised by tariffs. And then that would help pay for the tax cuts that he's got and increased spending. But as Ryan points out, what's happened to that plan?
Totally.
All of a sudden, that one of the legs of that stool has been kicked out. The money's not coming from tariffs in the way it was. But guess what? The US government still wants to ram the tax cuts through, still wants to spend up a storm. Doge has completely fallen off the radar. So that US budget deficit position isn't going to improve suddenly. And that's why there's one thing that hasn't surged in all this euphoria this week, and that's bond prices. Because bond prices and bond yields move in the opposite direction. We've actually seen bond yields rise because bond investors are looking at this and going, hang on, there's no tariffs now to help pay down the budget deficit, and you're still going to put the tax cuts through. So there's more risk of the US government defaulting. We'd like to be compensated for that risk, please. So I think that's just something to watch. I mean, in a way, we've fixed one short-term issue and left the big long-term issue completely unchanged. So, and in fact, perhaps even a bit worse. So I think there's plenty to play out here. There's still a lot of uncertainty around. There's still a lot of deals to be done. And there's this big question about whether A, the US budget deficit's really going to be repaired, and B, has Trump's drama hurt the relationship between America and the rest of the world? Does the rest of the world trust America like they once did? I mean, probably not. So that's going to have complications. But bringing it back home, Anthony, poor old Michelle Bullock at the RBA, who I think we tried to suggest would be our next Prime Minister on a recent episode, she's got to face the music on Tuesday, and the RBA board's got to make a decision on interest rates. How does all this affect the RBA's thinking?
Yeah, good question, James. I mean, like I said, in Australia, there's a lot of people frustrated by it all. And at worst, CEOs just have to try and focus on the long term, make decisions for the long term and not worry about tomorrow or the next day. But I mean, the RBA, they're in the position where they have to consider all this information, James, map it all out, forecast it, weight it, think about how it impacts the Australian economy, the Chinese economy, the US economy, the global economy, currencies, interest rates, bond yields, all that stuff. Like, it's an impossible job when the picture sort of changes every second day.
Yeah.
I mean, I don't envy them, James, because they've got to put all that together and then somehow come up with an appropriate monetary policy setting for Australia. So next week's decision, James, I think obviously it has to be about Australia, right? I mean, our cash rate's 4.1%. It's in restrictive territory. Both measures of inflation are back within the RBA's band for the first time in 3 or 4 years. It's broadly heading in the right direction, which is why markets are quite strongly predicting a rate cut next week.
Yeah.
But the spanner in the works, James, if there is one, it's that jobs number that was out on Thursday this week. Employment rose by 80,000 jobs in April. Labour force participation rate was also up a bit, so the unemployment rate was unchanged at 4.1%. Now, 4.1%, that's pretty strong, James. And
very.
The RBA's got two mandates: inflation and full employment. The inflation bit's all right, and the full employment's probably stronger than you'd expect. So it's got one hot and one cold. And normally when you got one hot and one cold, James, you normally sit, don't you? Like, I think, but the economists are all saying here there's a cut coming, and I think that's because of the global growth environment, the US, the trade wars, the market volatility, all that stuff, saying a cut is on the cards. So there's clearly a lot going on for the RBA.
You're on the fence, mate. Tell us what's going to happen, please.
Mate, if it was me, I'd be sitting.
Oh, okay.
But, I'm just getting knocked over by a weight of cut calls.
Yeah, so you think there'll be a cut?
Yeah.
Yeah, I'm in the same basket. I think when you step back from it, the RBA's played this year pretty well. They got the cut in sort of before the turmoil started, and then that got them completely out of any cuts during election campaign debates. They can do a cut here, recognising the progress on inflation, but not overheating things too much. And they can just sort of sit back, perhaps even for the rest of the year, and just wait and see how things go. So hand it to them. I mean, I think they've played this pretty well. I'm with you. I don't think there's a burning desire for a cut, and definitely not a desire for a 50 basis points cut. That would be an emergency cut that's not required. But 25 basis points, I think we can live with that. And with the caveat, as you say, that we just wait and see for the rest of the year. So let's see what we get on Tuesday, hey?
Yep.
All right, Anthony, let's switch gears a little and get back to our old stomping ground, corporate Australia. This week, private equity firm Brookfield offered to hand back the keys to Australia's second largest private hospital operator, Healthscope, waving the white flag after nearly 6 years of owning it. Anthony, this is quite an extraordinary story because Brookfield's a global giant in investing. It won a takeover battle back in 2019 and paid more than $5 billion for Healthscope. But then it got smacked by COVID and never got close to recovering. Now, you estimated this week that it's dusted $2 billion of its own money, while banks could lose another $1 billion, and Healthscope's landlords may have to write down the value of their properties as well. So what started as a pretty safe hospital investment now makes Healthscope one of Australia's worst ever private equity deals. Before we start laying into Brookfield, though, I reckon this is a good chance to sort of put the microscope on the growing world of private equity. How does it make investments, and how does things like blowing up $2 billion actually happen? So, Anthony, you're the expert here. Can you start by telling us a bit about the world of private equity? What is it, and why should our listeners be interested?
Private equity firms, James, they basically raise money, mostly from superannuation funds, sovereign wealth funds, rich families, offices, mostly offshore, to be honest, and use that money to buy businesses. Now, when they buy them, they run them privately. You don't normally find them listed on share markets or anything like that. They do it all as these big sort of private company structures. Now, James, they typically they buy them, they want to own them for 5 to 7 years, and then they look to sell it. They'll either sell it to a trade buyer. So, in a Healthscope's case, another hospital operator, for example, they might sell it to another private equity firm, like a bigger one or one with a slightly different angle, or they could float it on an exchange like the ASX. Now, James, when they buy something, they come in hot and heavy. They've got a new business plan. They're in a rush from day one. They often bring in new management. They load management up to the gills with options and everything, but will often get them to tip in quite a bit of money. So they load them up with debt as well and really try and incentivize them to push them in the right direction. And they'll try and grow the business in one way or another. It could be by buying smaller rivals, could be by launching into new territories, could be by winning market share. Whatever that they're doing, though, they're just wanting to grow earnings so they can sell it for much more than what they bought it for. Now, James, private equity firms, they come in all sorts of shapes and sizes. I mean, the traditional ones are leveraged buyout firms. They use debt and financial engineering as a big part of their strategy, and that helps magnify the equity return. So, for example, James, if a private equity firm buys a company for $100 million, right, and they use $50 million of their own earnings, $50 million of their own money and $50 million from the bank, and then they grow the earnings, they sell it for $200 million, they'll pay back the $50 million, and then the other $150 will be theirs. So they'll have turned their $50 million into $150 million, 3 times your money in, say, 5 years, 7 years. Sounds like a pretty good deal.
Nice.
Right? That's the sort of dream. So that's the leverage buyouts. I mean, there's also growth funds. They typically buy smaller businesses and try to grow them really, really fast by doing lots of acquisitions and doing lots of things that can grow their earnings. There's also turnaround funds that buy distressed businesses or broke businesses, to be honest, and try and inject new capital and new ideas and turn them around. But James, private equity, it's a big, big deal in the world of investment banking. And anyone involved in deals, I mean, they're constantly buying and selling assets. They look at heaps of stuff. Like, I'm talking about hundreds of things a year. Like, if you're one of the big firms, you have to justify to your investment committee why you don't look at something rather than you do. Like, it is your job to kick tires on everything. They'll do proper due diligence on a few of them, and and buy the odd ones.
But Anthony, we think of these guys as like, almost, it's got the word private in the title. They're working in the shadows a bit, in cool suits, and they're almost all blokes. They're all sort of walking around town, strutting around the place, getting deals done sort of on the sly. But it's important to recognise most of us are now private equity investors in one way or another through our super funds, right?
Exactly, James. That's why it's getting more important. That's why ASIC's really getting interested in them. That's why Australians should care. Our super system, most of us would have PE exposure through our super fund. It won't be the bulk of your super fund, but it might be 5%, it might be 10%, it might be up to 15%. Sounds small, James, but think about the way your super balance is growing. Hopefully it's going up, right? So the exposure you're getting to private equity is growing as well. So some of the super funds are trying to do their own private equity investments, style investments now too, James. And so this whole world's really getting bigger. Like you say, it's sort of operated in the shadows, and they've been happy to operate in the shadows, but now they're becoming a bigger part of the sort of overall economy. They're also going out there directly raising money off mum and dad investors, which brings a whole new layer of expectation on them.
All right. So, Anthony, what you've described here is a great little world. I love this idea of making 3 times my money in 5 years. Yes, please. So explain to us what the bloody hell happened at HealthScope to make this go wrong. Like, how does it blow up? It sounds pretty standard and pretty, easy.
Well, James, Brookfield just went too hard at this one. It was contested when they bought it, and they really had to push the needle, and they pushed it because probably like the rest of us, they thought this was a pretty stable, defensive hospitals business. Good brand, good market share, backed by government funding, both directly via Medicare and then from the private health insurance sector, which is propped up by the government. They saw Australia's ageing population.
Easy.
Private hospital operators make most of their money from elective surgery. That's older Australians. There's going to be more of that in the future. Exactly, like you say. Easy.
Yeah.
So to buy it, Brookfield borrowed a lot of money, and most importantly, it sold about half of HealthScope's properties to help fund it.
Right.
So they took $2.4 billion for the properties. They signed a long-term lease agreements. They chucked in $1.7 billion of their own money, $1.8 billion of debt, stirred it all together, and walked away with HealthScope. But what they ended up getting though, James, was a big hospitals group with a lot of debt and these long-term leases. Right, so the costs of the business were much higher structurally than they were before the buyout. Then COVID hits, elective surgery stops. Elective surgery is the big revenue spinner. So it was like that for a bit, and then COVID eases, elective surgery gets back up, and then they get hit by inflation, and particularly wages, James. The wage increases for the nurses were massive, but also absenteeism, sick leave, the agencies that they had to pay to fill those positions, their costs just went through the roof. And then you have other costs, associated with running the hospital. Think power bills, all the protective equipment that the hospital uses. All those costs went through the roof. Then you get surgery cancellations at the same time. Hospital admissions start tracking down because of COVID, because of other sort of society reasons. And mate, this thing just ended up being a perfect storm of woe for Brookfield.
And we should say on the other side, Anthony, you're really reliant on private health insurance premiums that are being paid by consumers to keep going up. But of course, those are set by the government, and the government doesn't want to whack people with a 10% increase in their or a 20% increase in their private health premiums. So those was held sort of artificially lower compared to the cost inflation. So that's another problem, isn't it? It looks like a safe sector, but it's got not only these cost pressures, but the overhang of government intervention that might not go your way every time.
100%. Like, James, government regulation, a government mandate can be a brilliant thing for a business. But also in tough times like this, when costs are so in focus, it can be an incredible weight around the neck as well, as it was for Brookfield.
Yeah.
Now, James, as it is today, so Brookfield offered to the lenders to hand over the keys. I mean, they effectively lost control of the business a little time ago to both the lenders and the landlords who are the ones really applying the pressure on them. But the problem isn't solved, though, both for Brookfield and for HealthScope. This thing is teetering on the edge. It could still go under. Opportunistic hedge funds are coming in and buying the debt. What do you think happens to HealthScope?
I think it's really difficult to say now, Anthony. The phrase you just mentioned, opportunistic hedge funds, at least when this business was owned by Brookfield, they had a view to the long term, and they certainly recognised the importance of these hospitals as social infrastructure. Aunt Jenny and Uncle Max, they're booked in for surgery in August, and is the hospital still going to be standing? And Brookfield wants to ensure that it is. Everybody wants to ensure that it is. But opportunistic hedge funds, they don't really have that incentive. What they want is to get a return, and some of these lenders just want to salvage something out of this mess. So it's interesting that, as you say, the business was in control of the lenders and Brookfield didn't have much option here. But we've entered a sort of interesting period where the new sort of owners or controllers of HealthScope have very different incentives to the old ones, very different priorities. So I'm not sure where this ends. Look, I don't think we'll see mass closures. HealthScope owns 38 private hospitals. I don't think we'll see them all go under. We could see some of them, some of the weaker ones, less profitable ones, or biggest loss-making ones closed. But I think the government would need to step in here if it got to that and provide some sort of lifeline to keep these places open. It's not like the public system's strong enough to cope with losing 38 private hospitals. So, there'll be some resolution found. But Anthony, this is going to leave a sour taste in everyone's mouth, isn't it? Like, what's the lesson here? Do private equity and healthcare not mix? Or, do we need more reform in healthcare generally and the way private hospitals operate?
Private equity and healthcare can mix, James, but in this case, they mixed terribly.
Yeah,
I think what we learn is the financial engineers can do things on their spreadsheets and that, but those great plans can be completely blown up when you get unexpected things like COVID. Now, the problem is always, James, comes back to debt. As soon as you load a business up with debt, you are flying by the seat of your pants. If you do that at the same time as you sell property, you increase your rent obligations, you've got this big fixed cost business with a lot of debt in volatile times. It's just a shocking recipe. And whether we should trust such a shocking recipe to be applied to an important business like a private hospital operator, I think that's the feeling that's lingering around the market at the moment.
Yeah, well said, Anthony. It's been a great tour through the private equity business. I think we'll continue to hear of private equity deals. They're not a bad thing in and of themselves, but occasionally, as you say, that mix of debt and cost can just be toxic. And in this case, we all might be losers. All right, Anthony, we'll come back after the break and we'll tell people why I'm going west next week. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, big week. Obviously on Tuesday, as we said, we've got the RBA board meeting. The world and his dog are barracking for a 25 basis point cut. So let's see if that comes to fruition. And then on Wednesday, the Australian Financial Review packs up the caravan and heads to Perth.
Nice.
For the mining summit, which is going to be great. We've got Andrew Forrest from Fortescue Metals Group. Mm-hmm. I'm doing a session with Simon Trott, who's the Rio Tinto's iron ore boss. Got lots on rare earths and critical minerals, which became a big topic. Well, not just in the Australian election, but everyone from Vladimir Zelensky to Xi Jinping is talking about rare earths these days, so that'll be great. And then on Anthony, Thursday in Sydney, we've got Wesfarmers Strategy Briefing Day. We'll get a look inside Kmart and Bunnings and all the cool things that Wesfarmers does. Okay, well, we love questions here on the Chanticleer podcast. And we've got lots of different ways for you to ask a question at the moment. You can send an email to chanticleer@afr.com. You can send a question in audio form and just record a voice memo on your phone, include your name and where you're from. And as we mentioned earlier in the podcast, you'll see that there's a widget now on the Chanticleer articles on afr.com that allows you to ask questions through there. We're really excited about all the questions we're getting. Please keep them coming and we'll get to as many as we can. But this week, Anthony, our question is from someone else from Perth, Jacob McDonald. So here's Jacob's question.
G'day, Chooks. It's Jacob from Perth. My question / comment today is regarding the productivity dilemma or issue we face in our country, which has been well publicised. Is there a possibility, a contributing factor to the productivity issue is the tied up capital that sits within the larger and older demographic in our country? You say the baby boomers who have acquired wealth over their lives, and that largely that wealth is sitting in their superannuation or in other assets, and they have less appetite for higher risk assets, and they're preferencing, say, passive income on yielding bank stocks or the ASX 200 as opposed to that capital being deployed into other parts of the market, that innovation of technology, whether that be AI or alike. Is that where the issue is?
Well, Anthony, this is a really interesting question from Jacob, but I'm going to do the old politician's trick, which is to answer the question I want to answer, which goes to Jacob's question about how does the superannuation system encourage productivity and investment in productive assets. This week has been dominated by this debate about Labor's planned tax or smaller tax break on unrealised gains in super funds with more than $3 million in them. It's become quite a heated issue, really, Anthony, hasn't it? In the pages of our papers, you can see it in the news. I think, from what you can see, that the Labor government, having won that big majority last week, is already feeling a bit of heat here. Anthony, how does that debate connect to what Jacob's talking about, the productivity question about how we get more bang for our superannuation buck?
Great question, James. It is a real big one. We're blessed with this massive superannuation system, more than $4 trillion in money. The more we can use that for good, the more that we can unlock it, use it for productive things, the better Australia should be. Right now, though, the way the politicians are viewing it, though, James, is as a source of revenue for the government, a source of tax, and that's what Canberra's sort of fascinated in at the moment. If you just want me to explain it quickly, so at the moment, James, when you're in the accumulation phase of super, so that's when you're investing funds because you're still working, you pay tax on your contributions of 15% on the way in, and 15% of on the investment earnings as well. Now, James, the government's looking to increase the tax on investment earnings by another 15% for funds with $3 million or more of assets. So they're effectively going to double the portion of tax that you pay on the earnings for anything you're earning off the $3 million plus. Now, that bit of policy, James, is probably the less controversial side. The big super balances pay more tax. I mean, okay, I think most Australians are going to say, sure, we need to raise money from somewhere, we can do that. Where this one gets controversial, though, is the way those investment earnings will be calculated. So for the first time, at least as far as super is concerned, is it will include unrealised gains. So that's the gains that you've made on investments that you haven't sold yet. So, for example, you might earn an investment property in your self-managed super fund and you collect rent on that, and that's income.
Yep.
You would pay tax on that earnings that you get from the rent at the moment, but you wouldn't normally have to pay tax on the value of the property increasing while you own it until it comes time for the actual sale.
Gotcha.
Now they're talking about taxing you on the increase as well. That's an unrealised gain. So that's a big shift, James, and that's where this debate's got really philosophical. Should we be taxing people for unrealised gains? I mean, in the past, like I said, in super, it's been a no. I mean, the supers, part of the problem here, James, is super's also become a bit of a tax-friendly parking ground for wealthy people's assets, which this debate is kind of playing out. And the problem is most prevalent with illiquid assets, things that you don't normally buy and sell, things you hold for a long term. And super's been a great home for them because you don't pay those unrealised gains. There's no pressure on you to sell them, and that can be a really good thing. If you want to put, and back to your point about productivity, if you want to encourage startups or venture capital or whatever, they like long-term money. You can make a long-term bet by your super and not have to pay tax as this thing's value goes up until you actually sell it. So it can be quite productive. So that, I mean, it's actually a really, really, really big debate that's playing out at the moment.
Yeah, and look, I think the debate is completely reasonable. It is unusual and in some ways, I think, illogical to tax unrealised gains. I think the concerns we're hearing from the venture capital and startup scene are completely fair enough. This is changing super is supposed to be a long-term game, and yet we're changing the rules quite regularly, it feels like to me. So I can understand the anger. I guess I would say, though, step back from it a bit, and you can see a directional shift, I think.
Yeah.
If you think about Australia's ageing population, our costs are going up, healthcare, aged care, NDIS. We need to meet that somehow. Now, we could tax workers more, but the pool of workers is shrinking because the population's aging. And so it gets harder to tax labour. I think it might get even harder to tax labour still when AI comes in and upends the jobs market. Where does that leave you? It leads you to taxing wealth more. And, whatever your feelings on this latest tax grab by Labor, and I think people are right to be upset. I think people should step back and think this is the direction the world's going to be going in. Aging populations, use of AI, erosion of the tax base. It's possible to see that the debate about how you tax, whether you tax labour or wealth, is going to increasingly move to taxing wealth. So I think this is the start of a much bigger picture debate, Anthony, that'll rage for a long time.
I think like the number of workers will increase. But the immigration is going to, and population growth will account for that. But it's the proportion of the population that's working. I mean, that's the problem. And the government revenue is going to have to come from somewhere. And if it's not coming from income tax, then, they're going to find it in other places. And that's what's going on.
Yeah. Jacob, it's a fantastic question. Thanks for bringing it up. And Anthony, thanks for explaining. That's the best explanation of this unrealised gains tax I've heard anyone give. So well done. I think we've all learnt something, and thank you for you've done the nation a favour by walking everyone through it. So well done, mate.
No worries. If only I had $3 million and it was relevant to me.
Indeed. Well, I'll come back from Perth with lots of stories. Hold the fort for us in Sydney, and we'll be back next week with plenty more.
Yep. Catch you next week, James.
Terrific. Thanks for listening. If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald, and it was produced by Alex Gow and Lap Fan. Our theme is by Alex Gow, head of podcast is Lap Fan, and the head of premium content is Fiona Buffini.
The Australian Financial Review.